Hi everyone. Today we're diving into OneSpan, ticker OSPN. Now, when you're looking at a high-security fintech specialist like this, the big question isn't just about how they run their business day to day. The real investor question is, what actually separates their routine operations from a true, structural competitive advantage? Let's break down the business and see where that moat really lies. First off, let's talk about who OneSpan actually is. Unlike the household names we all know, like DocuSign or Adobe, OneSpan isn't trying to be a broad, everyone uses it platform. By design, they've anchored their entire identity in high security and high compliance environments. We're talking about places where a simple email link or a standard login just doesn't cut it. Think about it. When trust is the actual product you're selling, you can't afford to be generic. Their mission is simple. Ensure people are who they say they are, and that documents can't be messed with, end to end. In this world, verification isn't just a feature, it's the whole point. So, where do you actually see OneSpan in the real world? It's deployed in high-stakes scenarios. Think about opening a premium bank account remotely. You need biometric liveness detection and secure signing. Those aren't just nice-to-haves, they're the gatekeepers. It's the same story with commercial lending, where clean execution is everything. OneSpan plugs right into systems like Salesforce to flag errors before they slow things down. They also handle high-value wire transfers with phishing-resistant tokens. And here's where it gets really interesting. With their 2026 acquisition of Build38, they've moved into mobile app shielding, protecting banking apps even on devices that might already be compromised. Let's take a closer look at digital account opening. Here's the problem. For premium accounts, regulators and banks need absolute certainty. They can't just cross their fingers with a basic email verification. OneSpan's solution is a heavy-duty stack, biometric liveness detection to beat photo or video spoofing, real-time government ID checks, and end-to-end secure signing right at the moment the account is created. It's about building a wall that's both high and smart. Moving on to commercial lending. This is a world of massive complexity. Think about it. Commercial real estate or syndicated lending deals are never simple. You've got multiple parties, conditional workflows, and mountains of audit trails. OneSpan's edge here is that they natively integrate with platforms like Salesforce and Guidewire. They catch not in good order, or NIGO, documents before they can stall a multi-million-dollar closing. That kind of specialized expertise is hard to replace. Now, let's talk about the scary stuff, transaction fraud. Account takeover attacks are a massive threat for high-value corporate wire transfers. OneSpan's defense is built right into the infrastructure using cryptographic tokens, whether that's software-based or their legacy DigiPass hardware. These are phishing-resistant by design, which is exactly what attackers hate. And here's a hidden edge. Because they've been deploying DigiPass for decades, they're deeply embedded in bank infrastructure. You don't just swap that out overnight. I mentioned the Build38 acquisition earlier, and it's worth a deeper look. OneSpan didn't just add another feature. They expanded their whole security stack with something called RASP, Runtime Application Self-Protection. Think about it. If a customer's phone has malware, who is going to stop the damage? This tech blocks key theft and prevents data tampering regardless of the device's OS integrity. It's basically like putting a bodyguard inside the app itself. So, after seeing all that, the big question remains, is OneSpan's moat real? The short answer is yes, but there's a catch. It is a real moat, but it's narrow and very specialized. They don't have the massive brand recognition or the everyone is on it network effects that DocuSign or Adobe enjoy. Instead, they've built very strong defensive walls within specific high-security niches. The strongest pillar of their moat is high switching costs. When over 60% of the top 100 global banks are using your infrastructure, you're in a good spot. Their net revenue retention sits around 103%, which shows that once they're in, they stay in. Why? Because re-engineering a bank's core security architecture costs millions and takes years. Plus, you'd need regulatory reapproval for any new vendor. Once OneSpan is embedded in a mortgage or wire transfer pipeline, it becomes extraordinarily difficult to pull them out. The second pillar is the compliance fortress. Think about it. Financial and government clients have to follow strict rules that generic tech players just aren't equipped to navigate. Whether it's EIDAS in Europe for qualified signatures or PSD2 mandates for strong authentication, OneSpan has the certified trust service provider status that acts as a major barrier to entry. You can't just build a startup and get these certifications over a weekend. And that's exactly why startups struggle to compete. The legal liability is a massive wall. In the EU, qualified electronic signatures have the same legal weight as ink on paper. Most new entrants can't handle that kind of liability exposure. Banks like BMO or the Bank of Cyprus want vendors with pre-certified, auditable infrastructure, not a cool new product that's still waiting on certification. OneSpan has spent over 20 years tailoring their stack to these regulations, and that head start just keeps compounding. But it's not all sunshine and rainbows. There is a weakness: the commodity trap of e-signatures. While their security side, the multi-factor auth and app shielding, is highly differentiated and hard to copy, standard e-signing has become a commodity. DocuSign and Adobe own the general market, which squeezes margins. Here's the thing: when a core feature becomes table stakes, your pricing power starts to fade. That's where OneSpan feels the most pressure. This creates a real structural tension. If you look at this chart, OneSpan's moat is at its absolute strongest when they sell an integrated, high-security bundle to a bank. But when they try to chase standalone e-signature deals in the general business world, that edge gets a lot thinner. Think about it. They're essentially moving from a protected fortress into an open battlefield where they don't have the same home field advantage. To summarize, the moat stands on 3 pillars. First, switching costs that really bite. Churn is just economically irrational for their big clients. Second, regulatory barriers that hold the line, though these require constant investment to maintain. And third, the commodity risk, which is the big catch. The weakest part of their story, the standalone e-signature, is also the part most exposed to better-funded competitors. It's a real moat, but it doesn't just maintain itself. So what's the strategic takeaway? Think of OneSpan as a safe house with multi-lock doors. It protects a stable, elite group of clients, but it's not exactly out there conquering new territory. You're buying a deeply entrenched position in low-churn, highly regulated niches with solid penetration in global banks. However, the price, under 11x forward earnings, tells you the market knows this is a narrow moat. It's a valuation priced for stability and defense, not for explosive growth. Thanks for listening.